Have you ever heard the quote, time in the market beats timing the market? It's a pretty popular quote among the investing community, and for good reason. I mean, just check out the growth of the S&P 500 over the past 70 years. Of course, there were dips in the market, such as the oil crisis in the 70s, Black Monday in 1987, the dot-com bubble in the early 2000s, and the global financial crisis in the late 2000s. But despite all of that, the S&P 500 returned an average of about 10% annually during this time period. I think this proves the validity of this quote and shows why so many people live by it. But I'm here to destroy the positive sentiment around this quote because I feel like people are getting screwed by following its advice. And don't get me wrong, in the long term, this quote is a great one to live by. But in the short term, it's costing you loads of dollar bills, yo. And since I'm in the business of trying to save you guys dollar bills, I figured I'd better bring this up. So, the main mistake I see a lot of investors make is striving to invest a certain amount of money each week. And don't get me wrong, that is a fantastic goal. If you're trying to achieve a goal like this, you are miles ahead of most people. But I think you guys are also missing out on a lot of potential returns. I would know because this is how I used to invest. When I first started investing, my goal was to invest at least $200 per week, and I kept this going for about 6 months. When the markets were down, I would invest more, and when the markets were up, I stuck with the minimum of $200 per week. As time went on, I began to notice a trend and came to a realization that this strategy was hurting my returns. First off, I was buying stocks at higher prices when I didn't need to be, and secondly, the dividend yields were lower because I was buying these stocks at higher prices. I was getting double-fisted, and it was all from my own doing. I wanted to stick to investing at least $200 per week, no matter how high the market was, because time in the market beats timing the market. So I changed up my investing strategy. Now I only buy the dip. And I know there's some people behind their keyboards saying, well, bro, you can't time the market. That's impossible, bro. Yeah, just keep buying stocks. Like, time in the market beats time in the market, bro. And to the people saying that, I'm just trying to reassure you here. I'm not trying to time the market. I'm not going out there and saving money for 10 years in the hopes of a big market crash. That would just be stupid. I'm just looking for the little fluctuations in the market during the short term and finding the optimal time to invest. Here's how I do it, and it takes some time because the first step I take is going through each stock in my portfolio and watch list and determining what is a fair value for the stock. Then I set a benchmark and only buy more shares when the stock price dips below my determined price. I like to call it an educated judgment call because, you can't predict where the share price is going exactly, but the determined fair value that I find is backed up by some analysis. So, I'll look at different metrics and look at the news, recent earnings, reports, that kind of stuff. And this takes a lot of work, so I only update my fair values list quarterly. What I've found is that some of my stocks will fluctuate under this fair value I set each quarter, which is great for me because, well, I'll start buying more shares. And because of this, I'm not forcing myself to invest $200 per week anymore. Now, what I do is I still add my $200 per week into my portfolio. I just don't buy anything until the pickings are good. And by doing this, I fixed the issues I saw in my old investing strategy. Now I'm not investing into stocks at all-time highs because I'm not forcing myself to invest money weekly. And since I'm buying stocks at lower prices, my dividend yields are higher too. So my money is working harder for me. It's just important to realize that the market will go through these bullish and bearish cycles in the short term. You just have to know how to capitalize when the market is bearish, and by setting values you feel good investing into companies at, you can, in a way, time the market. And it's pretty cool. Just the other day I was looking at my stock portfolio, and it happened to be at an all-time high, which was neat in itself. But the really cool thing was, a lot of my stocks weren't even near their all-time highs like they were a couple months back. So basically, I added on a lot of growth potential to my portfolio, and my overall dividend yield is higher, all from using this new strategy, which is daggum amazing. And I feel it's important for me to say this, that personally, I find this strategy works for me. But I'm not a professional, so just keep that in mind if you try this out. And that's all I got for today's video. So if you enjoyed, consider leaving a like and subscribing. You know, we are trying to put Investing Tree's logo on a NASCAR one day, and all your support helps us out tremendously. We got videos going up every Monday, so stay tuned. I'll catch you later. Peace out, fam.